What did you say in the first week of May to the eager students who've never seen a bond market like this and never seen the second derivative moves that we're seeing in markets as it relates to our economy?
Well, to my students, I told them that when the price goes down, the yield goes up.
Good. We have an opening, right? Where do we need somebody hired?
I think your viewers are probably on top of that one already. What I'm not sure your viewers are on top of is that I think this inflation is going to be pretty persistent, not where it is now, but way above where the Fed wants it to be. That means the Fed's going to need to stay at it. A Fed funds rate of 4% or higher, completely plausible, not at all priced into the market right now.
Because a lot of people, like Marky Patel, who was just on, believes that the Federal Reserve will come out and they will rescue the markets. And you're saying, no way. Why?
Because we are way above our inflation target. That is the job the Fed was assigned. You have a chair who talks about himself in the sort of wake of Paul Volcker and that historical shadow. He wants to bring that inflation down. Right now, the market is helping him do his job. I think this is not an accident. This is almost something that they are fine with.
We were laughing. We shouldn't have been laughing completely because the prospect of a recession is horrendous. Do you think it's avoidable, as Joe Biden said, or do you think the Fed, frankly, has to essentially allow that to happen to cool the inflation as it is?
You know, over the next year, I'm not that worried. I mean, I'm always at 15% for a recession. Maybe I'm at 20% now for the next year, but not much higher. Consumers are still spending a lot. There's people coming off the sidelines for jobs. There's more inventory rebuilding to be done. When you look after this year, that's when I get more worried. That's when more of the Fed rate hikes start to kick in and affecting the economy.
Jason, the punditry out there right now, I've never seen. It's worse than 2009. Those pundits are silent when they listen to you. Within the geometry of where we are, when we get interest rates to slam like they are, when you give us the fear of a terminal rate to 4%, how does that link in to the actuarial assumption of bonds and separately the total return of equities?
Yeah, I think that the long bonds haven't fully priced in that, you know, they think the Fed's going to stop at 3%. That might happen. We might hit a recession and they go back to zero, but that we could be at 4, well above 4. I think that's the modal scenario. When you look at something like the long yields, those just haven't gone up the same way they have on the front end of the curve.
Let's go up Benjamin Friedman, the giant of Harvard economics. Let's look back to the Napoleonic Wars or the Panic of 1870, the gyrations out of World War I, a fractured Europe and all. That's the arch fear that's out there for truly a generation or two that have not enjoyed what we're in right now. What does it do to a portfolio? What does it do to a pension fund?
Yeah, I mean, that interest rate shows up in every single stock price as on the discount factor. That's why, you know, almost every single stock price is going down right now.
Are you in the triple leveraged all cash fund like me?
You trying to pitch that? Is that what you're going?
No, well, they want me to start either an ETF or an NFT.
I'm sure.
I can't remember
ETF
which.
Or NFT. I can imagine with your face on it.
Deep into NFTs.
The fear here, Jason, is if we get a further first and second derivative move that we've all enjoyed for 4 months, that we're going to get a true negative 35% Dow. We're going to get bonds like we've never seen back to, say, the 30s. Do you ascribe to that?
I think that's a possibility. Look, I focus more on the real economy. I look at households that have $2.3 trillion still saved up from all the transfers they got over the last 2 years. I look at businesses who still are facing pretty good financing if they want to make more investments. I look at, you know, a global environment where the dollar's strength is, you know, worrying me, and the downdraft we're getting on net exports. So I'm looking at those factors. Overall, you know, I think we're going to see a lot of jobs this year.
So there are some people who believe that the more we see a momentum and a lack of recession now, the worse it will be later. And they point to people levering up on the consumer side once again in order to fuel their purchases even at higher prices. Do you agree?
I think that's possible. It really depends. You know, the Fed thinks inflation's coming down to 2.5%. If that happens, and there's sort of a 25% chance it happens, that'll be wonderful. We can avoid all these things. If inflation stays stuck at 4.5%, 5%, and that's roughly where the underlying inflation rate is right now, I don't know what sort of pain you'd need if you want to bring it back down.
1 minute. Long ago and far away, a Columbia professor saw a kid at Harvard and he said, "This kid's different. He's going to work with me." How dead on was your mentor, Joe Stiglitz, on globalization and his discontents? It's shocking.
I saw Joe. Joe doesn't love globalization, but Joe likes it here in Davos. I think we're seeing a pause in globalization. I think we're seeing a plateau. Don't think we're going to see that big a retrenchment because there are so many efficiency gains from operating all over the world. We'll see some recalibration, but I don't think there's going to be a big withdrawal from it, and I don't think there should be.